Hello guys, welcome to our channel Nota Bene Tech on Tube with our series of videos about international accounting standards, and in this video we're going to discuss a quiz on IAS 18 revenue. So let's see what it's all about in the quiz. The first question asks us to opt in for one of the following options on the question: when the outcome of the transaction involving the rendering of services cannot be estimated reliably, then revenue shall not be recognized to the extent of expenses recognized are recoverable. Only to the extent of expenses recognized are recoverable are the reliable estimation of the revenue. Okay, so the second option will be the correct one. When the seller retains an obligation for unsatisfactory performance not covered by normal warranty, they are said to have retained insignificant risk. They are said to have retained significant risk and rewards of the sale. They are said to have transferred the risk and reward of sale to the buyer. They have retains an obligation for unsatisfactory obligation not covered by normal warranty. That means that the significant risk and rewards are being still retained by the seller. So they have said to have retained significant risk and rewards of the sale is the correct answer. Which of the following is not covered within the scope of IAS 18? It is the sale of goods, rendering of services, interest received, changes in the fair value of financial assets, dividends received from investments. It is the sale of goods is covered, rendering of services is also covered. Interest received is covered. Changes in the fair value of financial assets is covered in IAS 39, so that is not the correct answer. But that is the correct answer. A company sells a product and at 100 euro, customers pay 80 euro upfront and 20 euro after 1 year from the date of sale. Based on past trends, there are no bad debts for the second payment by the customer. Which of the following amounts are recognized as revenue on sale? So that would be normally the after if there when talking about the bad debts, and there are no bad debts for the second payment, and the insignificant amount of the remaining due to the insignificant risk and rewards, therefore the amount deferred will not be as of value, because so we just have to consider the full $100 as the revenue to be recognized on sale. So that would be the correct answer. Dividends shall be recognized when the dividend is actually received, the investment is made, the investment is sold, there are adequate profits accruing in the business, shareholders' right to receive the payment is established. And when where the shareholders' right to receive the payment is established, it is not dependent upon the amount of the profits made. It is dependent upon when the profits are being adjusted against the losses that have been incurred in the previous years. So when the net amount is in plus, so the dividend would be distributed in shareholders. Then we say that yes, the shareholders right has been established. So that last one is the correct answer. Royalties shall be recognized on accrual basis. That is the correct answer. Okay, with substance of the development agreement. As per IAS 18, interest shall be recognized using the percentage of completion method. Percentage of completion method is the correct answer. In effective interest method is the correct answer. The difference between the fair value and the nominal amount payable is recognized as interest revenue. That is amount payable in cash compared to actual amount paid. And okay, the difference only between the fair value and the nominal amount payable is the interest revenue. So if a good is sold with a deferred payment, there will be an implied amount of interest payable. That would be an interest revenue, you can say, in other words. So that is called the effective interest method. So that is the only method used to recognize the interest. So that means you have to take into account the interest revenue, that is the difference of the fair value and the nominal amount. And if you can say in other words, so that if a good is has a deferred payment, okay, is sold with the deferred payment, obviously there will be an interest revenue or interest payable. Okay, so that one last one was the incorrect answer. So a company sells a particular product of €20 per unit plus sales tax of €2 per unit. During the year it sold 100 during the year it sold 1,000 units. How much revenue should it recognize as per IAS 18? So €20 plus sales tax of 2 per euro. During the year it sold 1,000 units. So the taxes are the recoverable amount, so they are not recognized as a revenue under IAS 18. So the taxes will not be considered. You just have to multiply €20 per unit into the number of units sold. So that would be the amount of €20,000 is the correct answer. Which of the following is a method of revenue recognition under IAS 18? Percentage of completion method is the method of revenue. Obviously, service statement not, delivery method, ownership method, percentage of payment method is not. First one is the correct answer. A limited ships goods by sea to a foreign company. B limited, as per the terms of the contract, any loss or damage to the goods until it reaches the factory of B limited shall be borne by A limited. In this case, when does A limited recognize revenue? When the goods would be reached in the premises of the factory E, in whichever factory B, in whichever country it located. So it means that you have to consider, or you have to recognize revenue when goods reach the factory of B limited. That is the last answer. Revenue accruing to an entity includes gross inflow of economic benefits of ordinary activities, proceeds from issue of stock and shares, none of the above. Gross inflow of economic benefits of ordinary activities, dividends paid by the entity, investment capital flowing into an entity. Revenue accruing to an entity includes dividends paid by the gross inflow economic ordinary. It is normally the gross inflow of economic or during the ordinary activities. Ordinary activities is the main point. So okay, you can read the explanation as well just for the clarification, but that is the correct answer. Revenue accruing to the entity includes gross inflow of economic benefits of ordinary activities, proceed from issue of stock and shares. That is obviously not an ordinary activity. So a dividends paid by the entity, dividends is normally is not an ordinary activity, because you don't know whether it has to be on the assumption that the profits are made when the previous losses are being settled in. Investment capital flowing into an entity, no, really. So gross inflow of economic benefits of ordinary activity is the correct answer. Revenue of entity shall be measured at cost of sales, fair value, cost of production, market value, none of the above. Revenue of entity shall be measured at cost of sales, fair value, cost of production. It is normally at cost. It is at cost. You have to measure the revenue at cost. That is the fair value. Sorry, that is another wrong. Under IAS, the revenue should be measured at the fair value of the consideration received or receivable. That is the correct answer. So that is, I have mistake noted. So when the interest received has accrued partly before the acquisition and partly post acquisition, which of the following is recognized as revenue? Pre acquisition only, both pre acquisition and post acquisition. Has accrued, received has accrued partly before the acquisition, partly post. Which of the following is recognized as revenue? Revenue interest would be the difference between the fair value and the nominal amount. So that would be the interest payable, and that would be a post acquisition only, because that is the only amount. And an agency transaction, it is a third party transaction only, so that the commission is only recognized. You don't need to recognize the revenue. There is no discussion of a revenue when there's a third party, because the significant risk and rewards are not being transferred over. So only commission is recognized as the correct answer. Revenue from sale of goods is recognized when the goods have been delivered to the buyer, the cash has been received for the sale of goods, the significant risk and rewards of ownership have been transferred to the buyer, and this is the correct answer. So finish the quiz. 13 of 15 questions answered correctly. So to the incorrect one, we can have the explanation just as a recap. What two were the questions that we answered incorrectly? So the first one was, as per IAS 18, interest shall be recognized using the effective interest method. The percentage of completion method is for IAS 11 construction contract. Is not under IAS 18. So in the, which we're going to discuss obviously in our next coming videos. And the second one was, revenue of entity shall be made at fair value. Okay, cost of sales is not the assumption, so it has to be made at cost of it has to be made at fair value. Okay, normally we discuss property, plant and equipment in IAS 16 that it has to be made at cost of sale, but not in case of revenue. It has to be at fair value. So these two were the incorrect answer that we answered it incorrectly. So the result is 86.67 percentage. So I hope it's a pretty fair one, but when you talk about the multiple choice questions, it is that part of examination in which you can score maximum. When there is a problem in scenario based questions, you can actually cover up the problems or the difficult part or parts of scenario based questions by answering or attempting the maximum correct answer from the multiple choice questions. So I hope this video will help you to get just an idea about IAS 18, and in the coming videos we're going to discuss some of the other standards along with the quiz, so that you can get an idea that what are international accounting standards all about. Thank you very much. Take care and have a nice day.